Welcome. I'm Isaac Meekum, and courtesy of the Utah Valley University's Planned Giving Department, we're thrilled to host this online workshop focused on savvy Social Security planning for Boomers webinar. As Utah's largest public university, Utah Valley University is committed to serving the community through accessible education and student access. We appreciate the community members and alumni who serve our students. We hope this workshop will help inform and inspire you as you plan your future retirement. This seminar is part of a series focused on important financial topics presented by professionals in retirement planning, estate planning, taxation, finance, and investment management. During this webinar, your video and audio features are disabled to create a focused learning environment. At this time, I'm honored to introduce our esteemed presenter, Nathaniel Evans, who will provide you with valuable insights.
Hi everyone. I put up this brain teaser before we start just to get people thinking before we dive in. So if you haven't thought about these two questions, please take a second and answer them for yourselves. In life, would you rather be early or delayed and pay a penalty or get a bonus? I'll be returning to these questions later. So welcome everyone, and thank you for coming. Today we are going to talk about savvy Social Security planning. What baby boomers need to know about their retirement income. When your parents retired, they probably didn't think too much about Social Security. They just went down to their local office as soon as they turned 65 or maybe 62 if they retired early and applied for benefits. They took their benefits for granted and didn't ask very many questions. But baby boomers approach the Social Security question in a different way, and it's creating a problem for many. People are hurting their retirements by making costly decisions about Social Security. This is the main challenge we'll try to solve today. There is a big need for Social Security education. Boomers are very interested in this topic, as your own presence here confirms. Many uninformed people make poor Social Security decisions about when and how to claim Social Security. I am here trying to make people smarter about claiming Social Security, and I believe that you'll be better prepared to make a good decision after this presentation. And with an issue such as Social Security, where everyone's decision is unique and personal to their own circumstances, I invite you to come in for a complimentary meeting where we can conduct a Social Security analysis for you and get an idea of what strategy would fit best into your overall retirement income plan. I will tell you more about this later. First, a few things to know about Social Security. You have many claiming options. One couple could conceivably have up to 18,000 ways to claim, but we normally look at the 5 most useful scenarios. Your decisions have far-reaching consequences. Most decisions are irreversible after 12 months. Your choice impacts both spouses. Social Security is not bankrupt and it's not a Ponzi scheme. Some of your friends and family have probably been helped by Social Security benefits. At the same time, your friends are likely not experts on Social Security. And what we're seeing is that baby boomers want to know, will Social Security be there for you? You've been told for years that the system is going broke, but now that it's almost your turn to collect, is that really true? You also want to know how much you can expect to receive. Before you can retire, you've got to know how you're going to support yourself. That means doing a budget, lining up all of your income sources, and knowing how much you can expect to receive from each. Social Security, because it's a relatively known quantity, represents the foundation of that plan. You're also probably asking when you should apply for Social Security. You may have heard that if you apply early, your benefits will be lower than if you apply later. But is it really worth missing out on all those extra checks to have a higher benefit later on? We're going to shed some light on that important question today. Something your parents probably never asked about is how is it possible to maximize benefits? There's absolutely nothing wrong with using the Social Security rules to your advantage. Today we're going to talk about the 5 ways you can maximize your Social Security benefits simply by knowing the rules and making smart decisions. And finally, you're wondering if Social Security will be enough to live on in retirement. You probably already know the answer to this. Social Security represents about 40% of the average retiree's total income, but by coordinating Social Security with the rest of your retirement income, you can pursue a comfortable, worry-free retirement. Most people tend to minimize the value of Social Security. If they believe that they are likely to get something back from the system at all, they think it will be a minimum amount, not really enough to count on. but Social Security is far more valuable than most people realize. Some people are worried that Social Security won't be around when they retire. This has led to a lot of misunderstandings and irrational fears about the solvency of the Social Security system. Let's now look at what Social Security trustees say. Every year, they publish a comprehensive report showing the long-range outlook for Social Security. Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers go into a trust fund and are immediately paid out to current retirees. Because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for current benefits. Right now, the trust fund holds about $2.7 trillion, which is invested in special issue Treasury securities. As baby boomers start retiring, these trust fund assets will gradually be drawn down. Over the next 75 years, costs will begin to exceed income. There are enough reserves that the system will be able to pay out 100% of the promised benefits until 2034. After that, if nothing is done to reform the system, income will be sufficient to cover just 81% of the promised benefits. Although the Social Security system is not in imminent danger, most people agree that the earlier reforms are instituted, the less painful they'll be for everyone. Here are just a few of the ideas that have been proposed. One is to increase the maximum earnings subject to Social Security tax. Currently, only $176,100 in earnings are subject to the 6.2% tax paid by you and your employer. Another proposal calls for raising the normal retirement age as life expectancies increase. Currently, full retirement age is 67 for people born in 1960 or later. Another proposal would change the benefit formula so that future increases would happen at a slower pace. This would affect the benefit of future retirees. And some are talking about changing the formula for cost of living adjustments. This would give retirees smaller benefit increases going forward, although the changes are expected to be minimal. You can learn more about Social Security reform proposals from the American Academy of Actuaries at their website actuary.org. The bottom line for baby boomers is that your benefits are not likely to be affected by much, if at all. So you can stop worrying that Social Security won't be there for you in the future. So, after thinking about that, you might be rightfully saying, what's a clearer way to think about Social Security? Well, here's a straightforward definition. Social Security is inflation-protected income that you can't outlive. Even after your death, your benefit could continue in the form of survivor benefits, as we'll see. Your premium or tax is listed on your paycheck receipt under FICA, which stands for Federal Insurance Contribution Act. You and your employers have paid the premium in every paycheck, so you want to be smart about how and when to collect this earned benefit. Let's look at its various features. First, Social Security is one of the few sources of income you can outlive. If you are worried about running out of personal assets in your old age, you need not to have fear with Social Security because it continues until you die. And of course, the longer you live, the more you will extract from the system. If your benefit starts out at $2,000 per month, and if you live 10 more years, you will receive nearly $300,000 in lifetime benefits. If you live 20 more years, you'll receive nearly $600,000 in lifetime benefits. And if you live 30 more years, you'll receive nearly $1 million over your lifetime. This assumes annual cost of living adjustments or COLAs of 2%. Second, Social Security offers annual inflation adjustments. So if your benefit starts at $2,000 per month, and if annual COLAs are 2%, in 10 years you'll be receiving $2,438 per month. In 20 years, your benefit will be $2,972, and in 30 years, your check will be $3,623. There is no way of knowing exactly what future COLAs will be, but 2% seems to be a reasonable estimate. Now, let's look at how much you can expect to receive from the system. When your Social Security benefit is calculated, it will be based on how much you earned over your working career and the age at which you apply for benefits. The formula for calculating Social Security is pretty complex. You may or may not want to follow along with this. Some people find the formula interesting. In a moment, I will show you a couple ways to estimate your own benefit. The general process goes like this. First, Social Security looks at your annual earnings over your entire lifetime, indexes them for inflation, and picks the 35 highest years' earnings to include in the formula. The indexed earnings are totaled and divided by 35 to come up with an average. If you don't have 35 years of earnings, the missing years will be filled with zeros. This has the effect of lowering Social Security benefits for people who have taken time out of the workforce, for example, to raise children. However, they may be eligible for spousal benefits, which we'll cover in a moment. Next, a formula is applied to your average index monthly earnings to determine your primary insurance amount. This is the amount you will receive when you reach full retirement age, which could be 66 or 67 or some age in between. Each year, COLAs are applied to your benefit to help you keep up with the cost of living. Here is an example of how the benefit formula would work for a baby boomer who was born in 1963 and who earned the Social Security maximum every year since the age of 22. His average index monthly earnings would work out to be $13,689. In calculating his primary insurance amount, the first $1,226 would be multiplied by 90%. The amount between $1,226 and $7,391, or the difference $6,165, would be multiplied by 32%. And the amount over $7,391, or $6,298, would be multiplied by 15%. These amounts would be totaled to come up with a PIA of $4,020.90. This is the amount the worker would receive at full retirement age. I told you this was complicated. Fortunately, you don't have to figure this out yourself. And some of you may be thinking, well, it's good to know how they calculate benefits, but why shouldn't I claim early at 62 instead of delaying to full retirement age or even 70? It's a good question, and it's also where some people start to get in trouble. That's because your monthly benefit will be reduced if you claim early. It may also be reduced by taxes, and Medicare premiums will be deducted, and benefits could be withheld if you work. What this means is that even if you maximize your claiming strategy, something I'm glad to help you with, the amount you actually receive will be smaller in reality because of taxes and parts of your Medicare coverage. Naturally, this raises a very good question. When should you apply for benefits? The decision of when to apply for benefits is one of the most important and most complicated. It can literally make a difference of thousands of dollars over your lifetime. It's also important to realize that the decision of when to apply for Social Security depends on many factors unique to your situation. These include your health status, your life expectancy, your need for income, whether or not you plan to work, and if you are a surviving spouse, whether you have other personal resources. That last part about survivor needs, which we'll get into in a minute, also factors into the next question. For most people, Social Security benefits alone will probably not be enough to live on throughout retirement. Let's take a closer look at how your claiming age impacts your benefits. Full retirement age is the age at which you can claim full unreduced benefits. It used to be 65 for everyone, but now we are seeing a higher full retirement age being phased in as a result of the 1983 amendments. For everyone born between 1943 and 1954, full retirement age is 66. For everyone born in 1960 and later, full retirement age is 67. For those born in 1955 through 1959, full retirement age is 66 plus some number of months. Now, remember that I said earlier that your primary insurance amount, or PIA, is the benefit you'll receive at full retirement age. So what happens if you apply for Social Security before full retirement age? Well, your benefit will be reduced. You'll receive a percentage of your PIA depending on when you apply. If your full retirement age is 66 and you apply at age 62, you'll receive 75% of your PIA. At 63, 80%, and so on. If your full retirement age is 67 and you apply at age 62, you'll receive 70% of your PIA. These amounts are actually prorated monthly, so you can apply at any time after age 62, and your benefit will be reduced by the appropriate amount. On the other hand, if you apply for Social Security after full retirement age, you will earn delayed credits of 8% for each year you delay. So if your full retirement age is 66 and you apply at age 67, your benefit will be 108% of your PIA. At 68, it will be 116%, and so on. After age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after age 70 to apply for Social Security. I'm guessing you're probably not too interested in calculating by hand your AIME or your PIA and the reductions and credits for early or late filing, or the annual COLAs that could raise your benefit in the future. But there are some ways you can easily find out approximately the amount of benefits you expect to receive. One, you can refer to your annual Social Security statement. These are now available online at www.socialsecurity.gov/myaccount. You will need to set up an account by answering a number of security questions. Two, you can use the retirement estimator on your Social Security account. This calculator taps into your specific earnings history after you enter your personal identifying information, including your date of birth, Social Security number, and mother's maiden name. Don't worry, their site is secure. Please note that the annual statement and the retirement estimator do not factor COLAs into your age 70 benefit. This means your actual benefit will likely be higher than they indicate, but our calculators do adjust for COLAs. So if you know your PIA, we can help project your future benefit. You might also want to try one of the three calculators on the Social Security website as shown on the slide. Feel free to browse around the site and play with the calculators. The obvious advantage to delaying benefits is that your monthly benefit will be higher. A baby boomer who has a primary insurance amount of $3,000 and a full retirement age of 67 would receive $2,100 per month if he applied at age 62, but $3,720 if he waited until age 70. The difference becomes even more dramatic if we multiply these amounts by 2% annual COLAs. If cost of living adjustments average 2% over the next 8 years, his age 70 benefit jumps to $4,359. It might be hard to pass up on Social Security checks when you can start receiving them as early as age 62, but if you live a long time, you'll be very glad that you waited. As you can see, the longer you live, the more income you will have by waiting until age 70 to apply. Okay, naturally, you may be wondering, how can you maximize your benefits? Let's look at a couple of strategies. The first thing you can do, while you still have some time, is improve your earnings record. Check your annual statement to make sure your earnings record is accurate. Mistakes are rare because the earnings on file at Social Security were reported by your employers when they submitted your Social Security taxes. But mistakes can happen, especially for self-employed individuals whose earnings records are taken from their tax returns. The next thing is to consider how you might be able to improve your earnings record. If you do not have 35 years of earnings, can you work a few more years so they will not be filled in with zeros? If you had several years of low earnings early in your career, can you work a few more years now while you are at your peak earning years so those lower earning years will be replaced with higher earning ones? Even if you start receiving Social Security but continue to work, your earnings records will be updated. However, it's important to know that if you start receiving Social Security before reaching full retirement age, and if you earn over a certain amount each year, $23,400 in 2025, $1 in benefits will be withheld for every $2 you earn above the threshold amount. Applying for benefits at the optimal time is the best way to maximize your Social Security benefit. The chief reason for delaying benefits is because that will result in the highest lifetime benefit for you and your survivor. But there is no one-size-fits-all answer to this question. The most important thing is that you apply at a time that is optimal for you. Did you know that Social Security benefits may be taxable? Let's look at maximizing your benefits by minimizing taxes. While the earnings test truly isn't a tax, it is a way in which the government takes back some of your income, so we're including it in this discussion. But it is different from true taxation of benefits, which we'll get to next. One important consideration in deciding when to apply for benefits is whether or not you plan to work. If you apply before you turn full retirement age in 2025, $1 in benefits will be withheld for every $2 you earn over $23,400. Now, it's important to note that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you turn full retirement age to make it as if you had applied later. This means that if some of your benefits are withheld due to the earnings test, your new benefit will be higher, as if you had started at age 63, 64, 65 instead of 62. Please do not let the annual earnings test discourage you from working. The more money you earn, the more money you will have. Social Security does not penalize you for working. Once the adjustments are made, you will end up with a higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. To avoid the earnings test entirely, just wait until you are full retirement age or later to apply for benefits. Now, on to the true tax of Social Security benefits. This table shows the taxation of Social Security benefits based on various income levels. Income in this case means provisional income, which includes adjusted gross income plus 1/2 of the Social Security benefit plus any tax-exempt interest. If provisional income is under $32,000 for a married couple, no benefits are subject to tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. If provisional income is over $44,000, up to 85% of benefits are subject to tax. The thresholds for a single individual are $25,000 and $34,000. In the case of married filing separately and living with a spouse, up to 85% of Social Security is taxable regardless of the income level. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to tax, depending on how much other income you have. You can minimize taxes on Social Security by lowering other income, especially investment income. But you should be aware that municipal bond interest, which is usually tax-free, counts as income for the purpose of calculating the tax on Social Security benefits. Anticipate the required minimum distributions from your IRA, which may cause you to be in a higher tax bracket and may cause some of your Social Security benefits to be taxable. Consider drawing down IRAs before age 73 or converting a traditional IRA to a Roth, which generates tax-free income. Delaying claiming Social Security will reduce the number of years your benefits are subject to tax. And think about how to reduce your expenses, pay down debt, and adopt a simpler lifestyle so you can make do with less income. Continue to manage taxes throughout retirement, not just the first few years. As always, please consult with your tax advisor about your individual situation. Remember that if you are 65 or older and enrolled in Medicare, your Part B monthly premiums will be deducted from your Social Security check. As you can see here, if you claim early, your Medicare Part B will always eat up a larger percentage of your benefit than if you wait until full retirement age or later to claim your Social Security benefit. The when to apply question is very complex and really requires a customized analysis, but here are a few points to remember. If you apply early, your benefit starts out at some fraction of your PIA, 75% or 80% or whatever, and remains at that percentage for the rest of your life. It does not go up to 100% when you reach full retirement age. COLAs magnify the impact of early or delayed retirement because the annual cost of living adjustment is applied to either the lower or higher amount. This causes the disparity to increase with each passing year. Your benefits may be taxed and further reduced by Medicare premiums. Do not let the earnings test discourage you from working. It's actually helpful for many. And finally, delaying benefits may give the surviving spouse more income. That's an important point to consider, especially if you're thinking something like this. I'm not going to live long, so why shouldn't I just claim my benefit while I can? The typical answer to this question is, for couples, you should always maximize the higher earner's benefit to protect the surviving spouse, who will step into that benefit after the higher earner dies. High-earning spouses are therefore encouraged to delay benefits to age 70, because that will give their spouses the highest benefit after they die. First, let's start by looking at how spousal benefits work. Social Security was instituted in an earlier era when most married women did not work. To give women a measure of financial security in their old age, the program offers spousal benefits. It's important to note that spousal benefits apply to either gender, including same-sex spouses. The spousal benefit is 50% of the worker's PIA if she applies for it at her full retirement age. So if John's PIA is $2,000 and Jane's PIA is $800, and if Jane applies for Social Security at her full retirement age, her benefit will equal 50% of John's PIA, or $1,000. This is $200 more than her benefit based upon her own work record. Here are the basic rules for spousal benefits. The primary worker must have filed for benefits. The lower earning spouse must be at least age 62 for a reduced benefit or full retirement age for the full spousal benefit. Spousal benefits do not earn delayed credits after full retirement age. I'm sure you have lots of questions about spousal benefits, so let's take a look at ways to maximize them. The goal is to maximize income for both of you while alive and maximize income for the survivor after one of you dies. It can be quite complicated, but by understanding all of the considerations and doing some calculations, it is possible for married couples to come up with the right solution for their needs. Let's look at a couple of strategies. The first thing to look at when you are coordinating spousal benefits is this. Is the lower earning spouse's PIA more or less than 50% of the higher earning spouse's PIA? If the lower earning spouse's benefit is more than 50% of the higher earning spouse's PIA, the way to maximize lifetime benefits is for both spouses to claim their benefit at 70. Our calculators show that if both spouses have average or longer than average life expectancies, this will maximize benefits for both of them over their lifetimes. If the lower earning spouse's PIA is less than 50% of the higher earning spouse's PIA, you might want to consider a hybrid strategy. Here, the lower earning spouse goes ahead and claims early. This gets income started as soon as the lower earning spouse turns 62 or whenever that spouse stops working. The higher earning spouse still claims at 70 in order to maximize the higher benefit over both lifetimes. It can be very complicated, especially with the recent rule changes. You really need to run the numbers. Let's continue as we look at how survivor benefits work, especially since many of you may be thinking, well, I'm widowed or divorced, so how does that impact my Social Security claiming strategy? It's an interesting question with a satisfying answer. If you're widowed or divorced, you may be eligible for survivor benefits, divorced spouse survivor benefits, or divorced spouse benefits. By coordinating these benefits with your own record, you may be able to increase your total benefits. But first, let's look at the basic survivor benefit a spouse would receive, hopefully after maximizing the other spouse's benefit. Survivor benefits can be somewhat complicated, but it's important to understand how they work because decisions you make now can influence the amount of the survivor benefit later on. There are two factors that influence the amount of the survivor benefit. The first factor is the age at which the deceased spouse claimed his own retirement benefit. If he or she originally applied for Social Security before full retirement age, the survivor benefit will be limited to his or her actual benefit or 82.5% of the PIA, whichever is higher. If the deceased applied at his full retirement age, the survivor benefit will be equal to 100% of PIA. If he or she applied at 70, the survivor benefit will include delayed credits. We'll see an example here in a moment. The second factor influencing the amount of the survivor benefit is the age at which the widow or widower claims the survivor benefit. If he or she claims it at 60 or 50 if disabled, the survivor benefit will equal 71.5% of the decedent's PIA. If he or she claims it at full retirement age or later, the survivor benefit will equal 100% of the original amount. They may, of course, apply any time between ages 60 and 70, and the reduction will be prorated. If both spouses are receiving benefits and one spouse dies, the other spouse may switch to the higher benefit. Here's a hypothetical example. Let's say Joe and Julie are married. Both are over full retirement age and currently receiving Social Security benefits. Joe's benefit is $3,600 and Julie's benefit is $1,800. If Joe dies, Julie's $1,800 benefit will stop and she'll start receiving $3,600. One important note about survivor planning is the loss of one benefit. Most widows and widowers need at least 2/3 of the amount of income they were receiving as a couple, so it's important to plan for the loss of one spouse's Social Security benefit. Even though it is often the higher benefit that will be retained, the death of a spouse means the loss of one Social Security check, regardless, which means less money coming into the household. Now let's see what would happen if the deceased spouse had delayed the start of Social Security. In this hypothetical example, Joe files for Social Security at age 70. His benefit is 124% of the $3,600 PIA for a total benefit of $4,464. Now if he dies, Julie's survivor benefit will be equal to Joe's benefit of $4,464. Survivor planning is a very important part of savvy Social Security planning. Decisions you make now can influence the surviving spouse's standard of living later in life. Here are some of the rules for survivor benefits. In order for the surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months unless the death is ruled an accident. To start benefits, the survivor must be at least age 60 or 50 if disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced, as it is for regular retirement benefits. Some of the same principles that go into deciding when to apply for regular retirement benefits also apply to survivor benefits. If you are married before age 60, you will not be able to receive a survivor benefit based on your previous spouse's earning record unless your remarriage ends. And divorced spouse survivor benefits are available if the marriage lasted at least 10 years. Let's look at that a little more since many people have been divorced and it's not a widely known or understood benefit. A divorced spouse can file for Social Security based on the ex-spouse's work record, provided the marriage lasted at least 10 years and the person receiving benefits is currently unmarried. Remember, men can receive divorced spouse benefits too. If the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for his benefit. However, he or she must be at least age 62. Here are the rules for divorced spouse benefits. More than one ex-spouse can receive benefits on the same worker's record. So if your ex-husband has remarried a couple times, all 3 ex-wives can claim divorced spouse benefits as long as each marriage lasted at least 10 years. The benefits paid to one ex-spouse does not affect those paid to the worker, the current spouse, or other ex-spouses. You do not need to know your ex-spouse's whereabouts, only enough identifying information that the Social Security people can look up his records. You will also need to provide documentation showing the dates of the marriage and divorce. If you are receiving divorced spouse benefits and you remarry, your divorced spouse benefits will stop. However, you may then be eligible for spousal benefits based on your new husband's work record, or you can switch to your own benefit, of course, if you qualify for Social Security. So if you're thinking, gee, this is really more complicated than I realized, I understand. Getting Social Security right plays an important part in people's retirement income plans, which brings us back to our Social Security brain teaser. You may have heard the phrase behavioral finance. It is the study of the influence of psychology on the behavior of investors. So for our brain teaser questions, people usually say they'd rather be early than delayed for many things in life, and they'd rather get a bonus instead of paying a penalty. That makes sense, right? But as we've seen in our presentation, when it comes to a Social Security claiming strategy, early is to penalty as delayed is to bonus. The government didn't set the phrasing up this way intentionally, but it certainly has influenced people who have only seen their claiming choices described as early versus delayed. We don't normally see the claiming question positioned as one of a penalty versus bonus, but I think you can see the value of framing the question in a manner, right? I think this little brain teaser is a good way to loop back to our original problem, review what we've learned, and then close with the solution. So here we go. This is what we started with our core challenge. People are hurting their retirements by making costly decisions about Social Security. And then we went through 4 insights designed to help us get an understanding of the problem and develop a belief in a solution that might work. In brief, the insights were: Social Security offers inflation-protected income for life, including survivor benefits. Your monthly benefit will be reduced if you claim early. Couples should always maximize the higher earner's benefit for the surviving spouse. If you're widowed or divorced, you may be eligible for benefits that can increase your check. And so that understanding of the problem brings us to our solution. Everyone needs a personalized Social Security claiming analysis to understand and when to apply and how their monthly benefit will fit into their overall retirement income plan. It is important to consider Social Security in the context of your other retirement resources, including pensions, IRAs, and 401ks, the required minimum distributions you'll be needing to take at age 73 or 75, your overall investment portfolio, and your plans for working in retirement. All of these resources should be coordinated to give you the income you need for the rest of your life. Please do not be afraid to ask for help. Retirement planning is easy when it's a matter of stashing part of your salary into a 401k or IRA, but when the time comes for you to convert your nest egg into an income stream, you want to make sure it doesn't run out. Social Security may be the bedrock of your retirement income plan, but it must be coordinated with other resources to give you the stability and security you deserve. Social Security personnel are very helpful, but they can't make recommendations. It is not their job to do long-range Social Security planning because they don't know what's going on with the rest of your personal finances. We've covered a lot of ground today, but you probably still have some questions. When should you apply for Social Security? What if you want to keep working? What if you've already applied? How much will your benefits be? How can you coordinate spousal benefits? What's the best long-term strategy for your situation? What should you do next? We would be glad to help you consider each of these questions individually and help you come up with a plan for your personal situation. The best way we can do this is to complete a custom Social Security analysis for you or you and your spouse. What we'll do is run a series of maximization scenarios to help you identify your best claiming strategy, whether you're single, married, divorced, or widowed. We can show you how your Social Security income stream under different claiming scenarios and help you take advantage of innovative strategies designed to maximize your benefits. At the end of the webinar, there will be a survey, and you can indicate if you'd like to schedule a complimentary consultation to discuss your individual Social Security situation. Thank you for attending today's webinar. I hope you found the information helpful and feel more confident about making Social Security decisions. Thank you for attending.